when is the best time to buy gold? Please take a moment to like and subscribe to keep the channel going strong. Thank you. This is a common question echoed over the years by investors of all stripes. Is there a better month to buy gold, a better quarter, or a better season? Is it better to buy during times of economic strife or when the market is booming? Can you time the market, or should you stick to a dollar cost averaging strategy? To find out, we took the most recent 10 years of price data and charted it out. And the data revealed some interesting facts. If we look at the last 10 years of gold price data, what we found was that December had the lowest average price of all months and that June had the highest average price. And we find a lot of analysis like this falls prey to a couple of basic errors. You may have seen some charts around the web that portrays the data this way. However, we took things a step further. First, if you set the y-axis on these charts to have a minimum value of 0, as it should, the data seems a lot less dramatic. It shows there's very little variance between the months. Same data, just portrayed a little differently. We then removed 1 year of data. We wanted to see what the change would be if the most recent year was removed. Would the trend remain the same? And we found that it did, with December being the cheapest on average and June being the most expensive on average. Now, December's average over the past 10 years was 1,411. June's average was 1,501. So there's a $90 difference on average between December's prices and June's prices. Now, when gold is going for roughly $2,000 an ounce, that's a 4.5% difference. Of course, there's a huge range of price movements in any given month, so we looked at the highest highs and the lowest lows, and over the past 10 years, the lowest price did actually occur in December. But August holds the record for the most expensive price in a month. The goal of any asset or investment should be to buy low and sell high. Now, does this mean you're guaranteed to win if you buy in December and sell in June or August? Of course not. Here's the rub. The lowest recorded closing price in June was 1,168, while the highest was 1,978. So in every month, there's a difference between the highest recorded price and the lowest recorded price between $800 and $1,000. As an example, if you had bought gold in December 2020, the average close price was $1,862, and in June 2021, the average close price was $1,835. But the prices varied a lot throughout the month. If you had sold at the start of June, you would have made money. If you had sold at the end of June, you would have lost money. So what is the data telling us? Well, at face value, it looks like if you were to blindly buy in December every year, on average, you would theoretically get a better price. But the truth is somewhat more complex. When you break the data down and look at the numbers closer, you see the variance in each month is too large for this to be a reliable strategy. Similarly, we don't find there is one quarter or one season of the year where you're going to have an advantage. So if not time of year, what about economic cycles? The rumor is that gold does better during recessions and holds its value. Is that true? Now, this is a bit tricky to assess because our sample sizes are so small. To get a larger sample size, you might be tempted to go back further in time and look at old recessions, but this is a bit of a mistake. Gold prices don't necessarily behave the same today as they did in the fiscal environment in the 90s or 80s or even earlier. Looking at how markets traded before the advent of the internet or the end of the Bretton Woods Agreement doesn't give us a useful comparison point. Even looking at recession to recession is a bit difficult because each one has its own characteristics. But that said, in 3 out of the last 3 recessions, if you had bought gold in the 3 months leading up to the start of the recession, you would have seen an increase in value during that recession. In addition, if you bought gold during the recession, you would have seen another increase in value in the subsequent 6 months after the recession had officially ended. So we are looking at averages when we talk about these numbers, so your mileage may vary in a practical application. But here are the numbers. If you had bought gold during the 2001 recession, the average value would have increased by 8% in the 6 months following the recession. If you bought gold in the 3 months before the recession started, you would have seen a 10.4% increase if you held it through the recession and sold it in the aftermath. Okay, so during the '08 recession, if you bought gold in the middle of the recession and sold in the 6 months after it ended, you would have netted a 17% return. If you bought gold in the 3 months leading up to the recession's start, that return would have been 36%. And in the short-lived COVID recession, buying gold through the recession and selling it after would have given a 13% return, while buying gold before the recession and selling it after it ended would have netted you a 23% return. So the trend seems to be that buying before a recession yields some returns during the recession and even larger returns after the recession ends. So is it a recession you should be watching out for? Maybe. But there is another variable that explains this phenomenon more fully. As we've noted in prior videos, the interest rates that the Fed sets has a lot to say about the price movement of gold. As it turns out, the Fed tends to cut rates whenever a recession occurs or they have indicators of great economic stress, and they have done it like clockwork in the last 3 recessions. The 2001 recession was officially declared in March 2001. The Fed had begun to cut rates in February 2001. In the Great Recession, the Fed began to cut rates about 2 months before the recession's official start date. And for the COVID recession, which began in February 2020, we know the rates were cut immediately in an emergency. And we know from past analysis that real interest rates tend to correlate negatively with the price of gold. So, when to buy gold? Well, timing the market is never easy and usually ill-advised. Some gold bugs will use interest rates as an indicator for when to buy, but there is a simpler alternative that doesn't require you to guess the Fed funds rate, and that's to use a dollar-cost averaging strategy to buy gold in fixed increments at set intervals. It's the same idea as putting a bit of money each month into a retirement account. Purchasing in smaller increments over time tends to yield lower returns, but it will also provide you with a reduction in risk. Generally speaking, most dollar-cost averaging strategies show gold yielding between 3% and 7% returns, depending on the assumptions used in the model. That's all we have for you today. Please remember to like, subscribe, and share with a friend. Thanks for watching, and we'll see you next time.